Hello everyone, this is Shilpa Shri MS from GFGC Bairapur. This is my third unit, this is my third session on the fourth unit, risk and return, and in today's session we are going to see what are the different sources of risk. In the second session and the first session we had seen what is the meaning of risk, what are the different types of risk and what are the differences between those risks. And in session 3 we are going to see what are the different sources of risk, and we are going to see the MCQs as usual. The main objective of this session 3 is to get familiar with the different sources of risk. By the end of the session you should be able to know what are the different sources of risk. So let us start with the session. In this slide we can see what are the different sources of risk. There are basically three sources of risk. First one being interest rate risk, second being market risk, and third being business risk. Coming for the very first source of risk, that is interest rate risk. What it is, let us try to understand. Interest rate risk is the variability. Variability is nothing but it is the difference in the securities return resulting from changes in the level of interest rates. Other things being equal, security prices move inversely to the interest rate. The risk affects bondholders more directly than equity holders. Before going further, what is interest rate risk? So, what is the meaning saying? The meaning is saying that interest rate risk is one source which is basically arised when there is difference in what? Difference in the interest rate, difference in the level of the interest rate. Whenever we speak about interest, we all know which are the securities or which is the investment vehicle which basically gets interest. One is fixed deposits, one is debenture, one is bond. Okay? So, these are the securities which basically comes with, basically tagged with a percentage of interest rate. So, whenever there is a variability, what is variability? Whenever there is a change, okay, in the return. What is the return now? Return is nothing but the amount which a person receive in the form of money based on the particular fixed interest rate is what is called as return. So, whenever there is any changes, any variation, any variability in the rate of interest, in the level of interest rates, then the interest rate risk arises. Now, we know that interest is not given to the equity shareholders, as equity shareholders are the owners of the company. For whom interest is paid? For the people who are giving loan in the form of debentures, in the form of bonds, or in the form of deposits. So, the people who invest money in debentures, bonds or deposits get something in return for their investment, which is called as return. How much they are going to get? That is decided by the percentage of interest which is basically fixed for such kind of deposits or such kinds of bonds or debentures. So, when there is interest rate risk, shareholders are not that much bothered, they are not that affected. Who is the person or who is the people who get affected? The people who get affected are debenture holders or bond holders. Going further, interest rate risk is the potential for investment losses that result from change in the interest rate. If interest rate rise, for instance, the value of the bond or other fixed income investment will decline. Say for example, now let us assume that XYZ company is issuing bonds with a fixed percentage of 10%. Okay? Like say for example, Mr. A invests in such bonds, like example 10,000 rupees, he invests 10,000 rupees with the intention of getting that 10% interest at the end of the year, or like for 10% for 10,000 rupees is 1,000 rupees. So, he is expecting his investment to become 11,000 including the interest of 1,000 rupees. What basically happens if a new investment vehicle or a new bond is launched in the market with 11% fixed rate? Okay. Now, say for example, Mr. A, who has invested 10,000 rupees for 20 years, he is expecting at the end of every year he will be receiving 1,000 rupees. So, at the end of 20th year, only interest he will be receiving how much? 20,000 rupees along with the investment, along with his investment which is he had initially invested of 10,000 rupees. So, what is at the end of this, at the end of 20th year, the investment amount which is rupees 10,000, it becomes 30,000 after 20 years. But let us assume that there is a new bond in the market, the company is allocating a new bond or they are issuing a new bond in the market for 12% interest. Now, if Mr. A want to sell his bond in the secondary market, the rate of his bond will decline, because the people who want to purchase a bond would always go for a higher return. So, that rather than 10% bond or 10% debenture, they would opt for the freshly issued 12% debentures, wherein the interest rate is more when compared to the bond which is issued in this market. Now, let the situation becomes vice versa. If the interest decline, on the contrary, okay, like Mr. A had purchased 10% bonds, now the rate of interest next time the company is issuing is, let us assume 8%. When it is 8% interest bonds, when the people who want to invest in the open market, in the secondary market, they would rather opt for 10% bond which Mr. A is selling rather than this new bonds where the interest percent is 8%. So, Mr. A gets the better rate for his bonds or debentures in the open market, in the secondary market, when compared to the new bonds which comprises only 8% interest. Now, let us go further and see what it is telling. Interest rate risk is the potential for investment losses that result from change in the interest rate. If interest rate rises, for instance, the value of a bond or other fixed investment will decline. Yes, if the interest in the open market increases, the resale value of such bonds will decline. On the contrary, if the interest rate declines in the open market, the value for the investment will hike in the secondary market. Now, let us see what are the key understandings of interest rate risk. First point, as interest rates rise, bond prices fall and vice versa. Yes, if interest rate rises in the market, the bond prices in the secondary market will decline, wherein if the interest rates decrease in the open market, the bond market will give a good return, good price for the bonds. This means that the market price of existing bonds drop to offset the more attractive rates of new bond issues. Secondly, the second point is interest rate risk is measured by a fixed income securities duration, with longer term bonds having a greater price sensitivity to rate change. Yeah, that is what I was just trying to tell in the example in Mr. A's case. If interest rate is measured for a fixed income, say for example for the longer securities like for 20 years, 15 years long term bonds, they have the great price sensitivity for rate changes, because he rather than waiting for 15 years, he can go for a new bond which is having attractive rates, or the people would like to opt for the new bonds with attractive rates than the bond which Mr. A has to offer in the secondary bond market. Point number 3, interest rate risk can be reduced through diversification of bond maturities or hedging using interest rate derivatives. So, you can one can take the help of the derivatives in order to overcome the risk which is posed due to the changes in the interest rate. Okay, that is it for this session. in this session we have tried to understood what is interest rate risk, why basically interest rate risk happens and the concept of interest rate. For the multiple choice question, first question is interest rate risk arises out of what interest rate risk arises? Option A, change in interest rate of a new bond, change in interest rate of existing bond, none of the above, all of the above. The answer is if at all a new bond is issued in the market, then only the risk is arising. Interest rate risk affects what? Bondholders, shareholders, none of the above, all of the above. We all know whenever we speak about interest, it is about debenture or bondholders or deposit holders, not the shareholders. So, the answer is option A, bondholders. If interest rate increases in the market, the bond prices also increase, bond prices declines, none of the above, all of the above. We know that if interest rate increases in the open market, the bond prices in the secondary markets will decline. It is option B, bond prices decline. The last question of this session, if the market price of the existing bonds drops, then the interest rates has risen in the market, the interest rate has declined in the market, none of the above, all of the above. We have clearly understood the concept. If at all the market price of the existing bonds in the secondary markets is increasing, then it is a clear indication that the interest rates have dropped. It is a vice versa situation. If the market price for existing bond drops, then it is clearly understood that the interest rate has risen in the market. The information which I have shared with you was taken from the internet. I have just linked it below in the sources of reference. Thank you so much. We are going to see the remaining two sources of risk in the coming session. Thank you.